There's an oft-mentioned tale from 17th century Holland that is repeated whenever there's a market correction. With the collapse in digital asset prices alongside bear markets in both stocks and bonds comes the blame game. Frequently, a big price plunge is blamed on a bubble, and the one example of hysterical behavior most favored by pundits is a tulip bulb fiasco from 5 centuries ago. Today, Rashid and I discuss why people are offside, using the tulip craze as any kind of comparison with what happens in real capital markets. In fact, we are collectively wrong to pay any attention to so-called bubbles unless they pose systemic risk, which is rare. Today, at the Rotterdam, where did this silly trope about crazed trading in tulip bulbs come from? And why should we stop it with the bubble talk?
The term comes from the South Sea bubble in England in 1720 and the resulting Bubble Act, which basically banned all stock trading for about 100 years. It was quite a big influence on the evolution of finance. You know, bubbles are it's not for nothing that they spark the imagination, right? They evoke irrationality, that a bunch of Dutchmen hung around in pubs and bid up tulip bulbs to the point they were worth more than houses, and then absolutely collapsed at the end. It's like a big party, right? Champagne filled, and then you get a big hangover at the end. And you know, we invoke the bubbles when we want to talk about the internet craze of the late 1990s. We talk about bubbles in meme stocks, in crypto, and most recently, there are a lot of these big talking heads, these famous investors are talking about being in an everything bubble, right? This idea that the Fed and the Treasury, by printing money and by injecting liquidity into the system, have created an asset price bubble in just about every single asset class. And this is not a new story. I mean, The Economist, as we talked about the other day, has been calling a housing bubble in Canada and other countries like New Zealand and Australia since at least 2012, and prices have at least 2x from there in Toronto anyway. So this bubble can go on for quite a long time. But you know, to some degree, people believe there's this stock bubble looks real, and there's a lot of you'll see on stock Twitter people comparing the price action of 2008 to what's happening in 2022, and predicting that we're going to collapse and that this bubble is about to pop. And people are also look back in other bubbles in history, like the 1970s stock market rally, and it looks much like where we are today. We're a little bit down so far, but could go down a lot further.
This sounds a lot like the foundation of a bubble, whichever one we care to discuss, whether it's in the stock market or in the tulip fields. The foundation of it seems to be fear of missing out, FOMO.
There's an academic view of bubbles that I really going to try to avoid. But there's this concept of rational bubbles and irrational bubbles. It's reasonably rational to go with the momentum for a long time. You know, being, especially your institutional investor, being early is being wrong, right? So you may think you're in a bubble. There are 2 problems with that. One, you might not be in a bubble. You might be in a rational market that's going to keep going higher and higher. Or you are in a bubble, but you're way too early. You know, stocks for the long run, you want to keep earning the equity risk premium. How do you do that? By staying in the market. The longer you stay in the market, the more chance you're going to have to make that equity risk premium of 10% a year for the last 150 years. There's good reasons sometimes to be in the bubble. We have to be very careful of what we do. Or how we think about them.
Well, maybe that's a separate discussion, is how to profit in bubbles.
No, we're going to talk a little bit about that. I mean, I'm fascinated about bubbles and crashes and booms and busts. For 30 odd years, I've been doing a lot of research, teaching, even learning. One of my courses in Cambridge, my master's was in economic history, was on this exact subject. And I spent a lot of time recently at academic conferences giving papers on the crash of 29. The story starts with a very, very excellent author, Charles Mackay. In 1841 wrote a book called The Extraordinary Popular Delusions and the Madness of Crowds. It's on every hedgies and traders' Christmas reading list for a long time. He's a great storyteller. But the tulip bubble is a terrible analog for investment bubbles. There's many, many reasons. We'll start with just 2 of them. The first one is it didn't actually happen. And second...
Yeah, that's the one that gets me, that it didn't happen.
And secondly, to the extent it did exist, which, I mean, it did happen to some degree. I shouldn't exaggerate its non-existence. But it didn't hurt really anybody and didn't cause any contagion. So it was a very isolated incident. It's a great story in Mackay's book, but it's not really an important historical incident. The thing about the Tulipmania and Mackay's book is his source literature was taken from a set of dialogues that were written quite long after the fact, and they were moralistic. They're basically, you're absolutely right. These were people who had witnessed the speculation in tulip bulbs, which was not to the extent that most people or some people believe, or at least Mackay believed. There was an obsession with rare tulips. They were starting to breed them and focused on their beauty. The group that was doing that were profiting from from breeding new tulips. And the people on the outside of that were jealous, basically. And then when the tulip bubble burst, they said, "Hey, told you so. Speculation is bad. You guys should all work hard in the fields instead of trading tulips amongst yourselves and not adding anything to society." It's not really a great example of financial speculation. I think it feels more like the Beanie Baby bubble, if you've ever heard of that. And
I certainly have. Beanie Babies were little soft toys that came in a bunch of unique characters, a lot of unique characters, and I guess the craze was, and it was legitimate, it was a consumer craze to collect as many of these toys as you could to get a huge Beanie Baby collection, with some sort of implication that there was a profit to be made by kind of cornering the Beanie Baby market. It was really weird.
That's right. Yeah. So artificial scarcity and, great marketing. Eventually, these babies that started at $5 ended up trading for as much as $5,000.
Nice trade.
By 2010, they're worth about 50 cents each. These kind of crazes, I mean, they're interesting, I guess, but they're not really important in terms of financial history or finance. And in fact, probably the most important book in economic history recently on booms and busts doesn't even cover the tulip bubble because it just wasn't important enough. Focusing up Tulipmania as a moral story about too much speculation and greed, or like Beanie Babies as the same moral story, it's not very interesting. It's a very bad analogy for how bubbles do actually fit into financial markets and financial history. So that basically comes to the idea of what do we know about bubbles? And the first most important thing that people forget is we never can tell when we're in one. Like, it looks so obvious in hindsight, right? When something goes straight up and straight back down again, like crypto coins did, crypto tokens.
Consumer mortgage-backed bonds in 2007.
Yeah, that's a good example, right? Nifty 50 stocks in the 1970s, internet stocks in around 1999, 2000.
That was genuine hysteria.
It's easy to see in hindsight, but the problem is you do not know you're in one at the time. That's issue one. That's one thing we do know. This has really important implications for policymakers and for investors, right? It looks obvious in hindsight when you're in a bubble, but you don't actually know when you're in one at the time or where you are within the bubble, even if you do know it's a bubble. The second thing is that bubbles can actually do a lot of good. And this is some of the most recent research on bubbles has shown this. And thirdly, not everything in a bubble is irrational. The idea that the bubbles are bad things because they go up, prices are irrational, so they go up and they go down. This is just a falsehood that we'll get into.
We don't know how long a bubble will last.
Well, this is the thing. So there's been some research done on stocks, at least, with the idea that, okay, we see stock prices go up 100% or 200%. And then we see if the price was more likely to fall or rise after that. And it turns out that for 150 years of stock, actually more than 150 years, that go back in time, I think about 200 years of stock prices, the answer is no. So the chance of the market giving back its gains following a doubling in value are the same as if it hadn't doubled in value, i.e. fastly rising prices does not predict fastly falling prices later on. If there's a doubling in the market, it's historically speaking, prices are more likely to double again than go down.
Is that true with the commodity markets in modern times? Because that's the concern right now, is that what we're seeing on the inflationary front it might be a bubble, might be periods of being bubbly, but in truth it might not, back off these prices.
I think that's a topic for another day, but the one thing I will say, because there's a lot going on there, but no, commodities are mean reverting, right? They don't go on up infinitely. To the extent that there could be bubbles in the commodity market, that could be true. Something we'll talk about is why they exist and why they're very, very difficult to profit from. And that's because, as you know, Jeff, the front month is the one that goes up and down the most, right? When supplies are scarce, the prices for immediate delivery of commodities goes up, but the long-term price of commodities may not go up as much, if at all. And you get this inverted curve where the spot price is much higher than the forward price. But
where oil has existed for years.
Yes, absolutely. So it's very, very difficult to trade that front month for delivery. And so no matter, even if prices rise and fall, it's very difficult to profit from that. But the thing is, if you don't know when a bubble started, you actually don't know when it's ended. And I'll give you the best example of that. And we've talked about it at least twice already. So it's going to be something we'll probably talk about it every episode, which is that look at Amazon. Look at the quote, air quotes, bubble in Amazon stock in 1999. Buying in that so-called bubble, even at the all-time high, you're 20x from there on Amazon, right? It's at the top. So that was definitely not, right, the end of the bubble. if indeed there was a bubble, it's called, basically the rise in price of Amazon, which, it's come off quite a bit since, right? So maybe that was a bubble. Well, exactly. But what was the bubble, right? You don't know where you're in a bubble. You don't know you're in it at the time. You don't know how long it's going to go on for, and you don't know when it's going to stop. And when it looks like it stopped, did it actually stop? And a bubble can go on for a very long time. Let's say Tesla's in a bubble. It's been a bubble for years, right? If that's true. When you sell out because you think you're in a bubble, you're missing the equity risk premium. You're missing stocks for the long run. And this is a problem with bears, right? It's always a problem with bears. The example we used a while back on Macro Talking Heads and Doom Porn was one economist, Canada's most famous economist, who basically was bearish before the global financial crisis, but remained bearish until 2014, so missed almost a doubling of prices. He and his clients have missed most of the bull run because he thought we were in a bubble. This is a very costly mistake, to be out of the market in the longest credit expansion ever.
It's really dangerous to use the classification bubble, the term bubble, if you're not certain that you're like, I think it goes back to the episode we did on making macro calls, where you're making short-term calls on the market and you're saying we're in a bubble. You're making a short-term call because the public perceives the word bubble as something that's not going to last very long, never mind 20 years. And then take 80 years to come back to where it was today. Not very attractive for the day traders. The connotations and denotations on that word are miles apart, and they trigger. This is another method of getting people excited about things. If you're writing research reports and you mention bubble, that's a very serious thing to say.
You're absolutely right. So you made two extremely important points, better than I did. One is you said that a bubble is it's a judgment, right? It feels better because you can label it, right? Oh, right. These meme stocks are in a bubble. Beanie Babies are in a bubble. Just like tulips were in a bubble, right? And those things are true in hindsight. What is not immediately obvious is whether or not even electric vehicles were in a bubble in 2020, 2021, right? They've come down a lot. Some have come down 95%. But was that a bubble? We don't know yet. The bubble might not be over, as we saw with Amazon that was down 92% and now is up 20,000% or whatever the number is.
The big EV vehicle name, of course, is Tesla, and that's had a 66% retreat in 2022, which is headline news. But again, not indicative that if it's in a bubble that the bubble's over.
The whole thing is really important here because we seem to always want to, even the libertarians in the markets, because then there are a lot of them in financial markets, they seem to always want the government or someone to do something about it. That's, the Fed was faulted for not raising rates in 28, 29 to deflate the speculative bubble. Even Milton Friedman, who is reasonably, and even Austrian, a lot of the Austrian school would say, who are reasonably free market oriented, extremely, I would say, not reasonably, would say that the Fed didn't expand the money supply enough during the crash. But the thing is the Fed, is the government the right people to call the top of the market if we don't even know? I mean, at the time, around that time, 1929, we had this book came out, Stocks for the Long Run. Irving Fisher, the most famous economist of the day, was saying it's a new paradigm. We have new technology, which we did. We had all sorts of new technology. We just got ahead of ourselves to some degree. And it's like, we don't trust our governments to keep the streets pothole free. Why should we trust them to know when we're in an asset bubble and to do something about it?
You just hit the nail on the head. Yeah, you've hit the nail on the head for me. The word bubble, or my perception that there's a bubble taking place in some area of the capital markets, has never been as frightening to me or as ominous as what the government's reaction might be. Because if these bubbles create a hot button topic, and especially if it's an election year, you can end up with some pretty strange legislation coming your way for a market that may or may not benefit from that interference.
It's a bit like German hyperinflation, right? The tulip analogy is a bad one. That fastly rising prices that seem to go ahead of fundamentals is morally wrong. It's morally wrong to permit wanton speculation take over ahead of fundamentals. Just like it's morally wrong to print money so much that you get hyperinflation. But that's the wrong lesson in hyperinflation, and it's the wrong lesson here. It's so easy to want to look for someone to punish, right?
Bad guys.
Right? When people lose money. Harmed citizenry, they look for scapegoats. They basically start vilifying the market. They say, well, that's what's happening in the crypto market, right? What kind of market is it that most of the tokens have fallen, 92 to 95, 99%? That's crazy. Someone should do something about that.
Yeah, do something about that. But the horse left the barn, moved to the next farm, raised a family, and died. And now you want to talk about putting locks on the gate.
That's right.
It's always that way. And then they come charging in and go, "This is terrible. We're going to move in directly, and we're going to take over, and we're going to regulate these things." Well, that's post-occurrence, post-tragedy. So thanks, but this has already happened. And quite frankly, they marketed, if we're talking about FTX, it was to anybody who would be getting involved in crypto transactions, as you pointed out when we talked about that subject a little while ago. The more sophisticated participants in the market would have looked at that and said, no, that's it's in a jurisdiction that I don't want to be in. They're not regulated, and I don't know what they're doing with client money. Mm-hmm. So I wouldn't be involved. So the fact that it hurt tons of people, including some who should have known better, I had no doubt about it, some pension funds, etc., is now triggering a huge influx of politicians who say, I have to look out for the little guy, and we're going to take care of these bubbles. And I'm right away the word came up again, because the cryptocurrencies, of course, have gone through a massive contraction. So again, it may or may not be the end of a bubble. I don't see it that way at all. I just think it's a moment in time. And right now, the story really is about the regulators fighting over who gets to take this on, because that's how they thrive. That's how they maintain themselves, if they've got more and more jurisdiction over larger areas of the capital markets, versus actually going in there and preventing bubbles. That's not going to happen.
I think it's really well said. I think that the closing the barn door, like you said, after the horse is gone and long gone, is really appropriate here. I mean, politicians, in regulation, we talk about politicians engaging in Pavlovian regulation, right? Once the harmed citizenry are looking for scapegoats, they'll pass anything just to look like they're doing something to make the populace happy. After the South Sea bubble in 1720, the British government made it basically near impossible to raise funds in a tradable joint stock company for 100 years. It was because a bunch of people, a religious movement that was concerned with moral decay, seized on the incident and started lobbying for change in London. That's so dangerous, right? You misidentify the problem and try to solve it with onerous regulation. We want to stay away from that idea, right? And
you mean like causing a tenfold increase in the number of people employed and profiting from organized crime by introducing prohibition, stuff like that?
Absolutely. And so it's not just the fact that you don't know if you're in a bubble or not, when it starts, when it ends, when you're in the middle of it. And we shouldn't expect politicians to know. We shouldn't blame policymakers and politicians for the fact that the prices go up a lot, and sometimes they come down a lot. And in the middle, it looks like you might have been in a bubble, but you're never even sure, sometimes for quite a while. The other danger of trying to stop a bubble is that we know from research now that bubbles can be quite good for society. And the example I always trot out, and I don't know if I've already trotted it out, Jeff, in our podcast, is global crossing, right? Sort of the credit expansion, the internet expansion of the late 1990s, there were a lot of bad ideas got funded, but a lot of really good ideas got funded, but they just got ahead of themselves. And so global crossing was responsible for putting fiber optic cable along the bottom of the Atlantic. It went bankrupt during their crash, but those cables were there, right, and were ready. And without them, without that bandwidth, Amazon couldn't and Google could not have done what they did. Railway boom. A lot of people lost a lot of money. Most people lost all their money on railways, but the railways.
Hard to imagine now, isn't it?
Yeah, but the railways were there when we got global trade. We start when the breadbasket of the Midwest started to produce grain for the rest of the world. Why? Because there were railways.
So most bubbles, or many bubbles, aren't irrational at all.
Well, bicycles and automobiles, right? These happen during technological times of technological advancement. Because these things are good for society, right? Where the money, okay, it's too much money, it's inefficiently utilized, but this money is going in to take advantage of new technologies. That's an important use of capitalism, right? And we should be the ones, as a society, decide what's going to work, what we should spend money on. That's the role of the market, right?
Well, and I think we've done a good job of defending bubbles, and somebody has to stand up for the poor things. So let's do a set of conclusions. So let's do a synopsis.
Like you said, FOMO, I think, at the very top of the show, right? But who cares? Caveat emptor. I mean, are these moral failings? I mean, maybe. Who cares? Is it that we just want to laugh at gullible investors ex post, and that's why we create these bubble narratives? I mean, that's basically what Mackay was doing. He took, the book he cited was exactly that, was basically laughing at these crazy people that bought tulip bulbs and that were worth more than houses. Just because we do have those kind of events doesn't mean that that's what's happening in our stock markets. Right? It's not the same. The stock market is driven by real economics. It's right. The Beanie Baby doesn't have any use at all, but the stocks do, right? And the fact
the Beanie Baby bubble never scared me. But if a government official had said we're establishing a Beanie Baby Control Commission and we're going to put it under the Commodity Futures Trading Commissioners, if something like that had happened, if they had said, "Oh, there's a bad guy behind this," I would have been a little bit concerned.
Yeah.
I mean, I think officials, for the most part, are right to ignore them.
Yeah, and we should all ignore them in a way, right? Classic, sort of go on a little bit more about this moral judgment is it's the hate that Cathie Wood gets, right? ARK Invest, she bought a lot of zero revenue and zero income companies because they're the tech of the future. She's been wrong for the last year, 8 months, 9 months, right? Very wrong, right? I mean, Tesla's down 65%. I can't remember how much ARK Invest is down, but it's down probably as much. Should we vilify her? Is she wrong? How do we know? Where are these prices going from here? Are we going lower? Are we going higher? I have no idea. And so we shouldn't moralize about it. We should just let the market decide.
She loves to talk about how things will look 5-10 years down the road. If you're going on that ride, you have to be prepared for, as we've said over and over on this podcast, that, sometimes things will get rough. Rising rates, the convergence of interest rate increases with high valuations is the recipe for a big VIX number. I mean, you're going to get market volatility whether you like it or not. There's no way the market's going to plane along in the post-2008, during COVID period as if there's nowhere to go but up when you've got government bonds over 5% midterm and you've got a lot of other things you can do with your money. You just can't compete with that asset at the same way you were 2 years ago.
Right. So that's a very good point. And that's something we didn't talk about really at all. And this is probably a good time to talk about it, which is what can we do about bubbles? One thing that Quinn and Turner in their book identify is not only that there's bubbles tend to happen during periods of extreme technological advancement. They also generally happen at a time where there's a lot of excess liquidity, which kind of makes sense, right? This idea that we need money to buy things, and if there's more money than we need for the real economy, it might go into speculative assets. That doesn't seem crazy. It also doesn't seem crazy that banks might want to lend more during these times. So not only is maybe the government expanding money supply, but also the banks are expanding private money as well. We can easily imagine that this so-called excess liquidity or too much liquidity, hate making judgment calls like this, but let's call it that, might be something we want to keep out of the system. And a great example of that is the global financial crisis. Also the COVID crash, and even also the 2018 repo run. There was definitely excessive liquidity. In the case of the global financial crisis, it came from excessive leverage and maturity mismatches, right? With very, very low capital charges on shadow banks. So if we're going to do something about tempering the flow of funds into new technology, and I guess somebody could call subprime mortgage securitization a new technology, what we might want to consider is having rules where we ensure that there isn't so much leverage in the system, that the market, if it's really a bubble and it bursts, that the whole world is not destroyed like it could have been during the global financial crisis. The idea is that we can regulate banks, we regulate shadow banks that take these kind of risks, and make sure that we know where those risks are. And I don't think we're there yet, but that is something that regulators are doing better since the global financial crisis. And so
bingo, I think you hit the nail on the head. It's fine and dandy if the general public, especially that caught up in a communication silo on the internet, gets all hyped up about meme stocks and wants to trade tulip bulbs, bulbs up to $1 billion a bulb. That's fine. But if banks get involved, if they're part of the bubble, if they're feeding it, if they're throwing gasoline on the fire like they were during the expansion of money or over that entire decade after the global financial crisis, that's not good. Or going into it, actually, is a better example. If you're participating, if you're out there buying a house as an individual and you're participating in a gigantic scheme that the banks are fueling, that's where the systemic risk comes in, and that's where bubbles turn into catastrophic events. In general, it's not a catastrophic event when the public just happens to go, chasing after something.
Yeah, that's right. That's right. The global financial crisis and 1930 to 32 are great examples of a disaster. In one case, the Great Depression, in the other case, the Great Recession, that were only a factor because of the leverage that was in there. We fixed the banking system with FDIC insurance and more capital requirements and things like that after the Great Depression. But the regulators missed that the shadow banks that didn't have the protection of the banks, the liquidity backstop of the Fed, FDIC insurance, etc., the shadow banks didn't have that. And so we had to bail out the shadow banks that time. Otherwise, we would have had, or could have had, a Great Depression again. So if we can sort of keep that part under control, I think we should just let the market be free. I mean, I don't think that's controversial, especially among financial professionals. It's been an incredible allocator of capital for 150 years, an amazing creator of long-term value for 150 years, right? 10% returns annually for 150 years. And even if sometimes it can be wrong, right? Prices maybe rise too high for some time. Do we know it when we're in that time? No. And fall too much? Even if sometimes the market's very wrong and misses the fundamentals by many factors in some cases, many times wrong, it's still smarter than us. And so do we really want to miss or crush the equity risk premium out of our investments just because a few fads happen once in a while and people lose money because they're a little bit extra greedy? I would say no. Prices going up and down a lot. Difficult to predict, and it's not morally wrong, is the way I would conclude. At The Rotterdam is a conversation about topics related to people's interaction with money.
We talk about financial markets history and, importantly, the many things that are connected to our financial systems, issues we think should be understood by more people. If you like the show, please follow us. Comments and questions are welcome via the links on our website. For information on Dr. Rashid Saluddin and myself, Jeff Sandler, and for links to important references, please see our social media sites, including Twitter and the website at therotterdam.com. Thank you for listening.